Welcome to The Explainer. Today we're digging into the latest quarterly results from India Shelter Finance Corporation. We're going to see exactly how they're navigating a pretty tricky economic landscape. So, you gotta ask, how does a company actually manage to grow when all the signs are pointing to an economic slowdown? That is the big question for India Shelter, and their recent performance is a really fascinating case study. So, get this. On their recent earnings call, the CEO basically painted a picture of two different Indias. On one side, you've got some urban areas facing headwinds. Things like digital payments and car sales are slowing down. But then you look at rural India, and it's a completely different story. It's showing incredible strength, thanks to a great harvest and good monsoon rains. This split is the key to understanding everything else. All right, so here's the game plan. We'll start with that tale of two economies. Then we'll hit the Q1 performance numbers, peek under the hood at their financial engine, see how they're managing risk, and finally, look at their blueprint for what's next. So even with all those mixed signals in the economy, India Shelter came out with a really powerful first quarter. Let's look at the numbers that really pop. First off, check out their total loan book, their assets under management. It surged to over 8,700 crore rupees, a 34% jump from last year. That tells you the demand for what they offer is still incredibly strong. And this wasn't just about getting bigger for the sake of it. No way. This growth hit the bottom line hard. Their profit after tax shot up by a massive 43%. So they're not just growing, they're becoming way more profitable. And that brings us to this number, return on equity, which hit 17.2%. Now, this is a really key metric, right? It tells you how efficiently the company is using shareholder money to make a profit. And hitting over 17% for the first time since their IPO, that's a huge deal. So you're probably wondering, how are they pulling this off? Well, it all comes down to focus. Their customers are overwhelmingly self-employed folks, living in those smaller Tier 2 and Tier 3 cities. A lot of them are in low and middle income groups, and get this, they're often taking out their very first home loan. This is a massive, underserved market. Okay, let's pop the hood and look inside the financial engine to see how this super focused strategy leads to such strong profits. Okay, this is where it gets really interesting. Look at how these three numbers play together. Their yield, that's what they earn on loans, is holding steady, but their cost of funds, what they have to pay to borrow money, is actually going down. And what happens when that happens? Their spread, which you can just think of as their core profit margin, it gets wider. In this case, it's up a very healthy 20 basis points. And it's not stopping there. Management is pretty confident this trend is going to continue. The CFO, Ashish Gupta, came right out and said it. We have seen 20 BPS reduction, and we expect another 20 BPS cut by the year end. That's a direct boost to their profits right there. Okay, so fast growth is great. But with any render, there's always that one big question lurking in the background. What about the risk? Are the loans they're making actually any good? So to get a handle on their risk, you need to know this term, 30-plus DPD, or days past due. Think of it as the canary in the coal mine for a lender. It's the very first warning sign that some loan payments might be in trouble. And boom, this chart lays out the challenge perfectly. This key early warning sign saw a pretty noticeable jump this quarter. It went from 3.1% all the way up to 4.5%. That's a clear signal that some of their borrowers are starting to feel the economic pressure. So, what does management say about this? Well, the CEO, Rupinder Singh, broke it down into two things. He said part of it is just seasonal weakness, something they expect. But the other part is the broader macroeconomic pressure that's affecting the whole industry, not just them. But, and this is a really important but, we need some perspective here. While those early warning signs are up, it hasn't turned into a big problem with actual bad loans. Those more serious delinquencies, what they call gross stage 3 assets, are holding steady at just 1.2%. So for now, it looks like their risk management is doing its job in containing the issue. So, what's the game plan? How do you keep this growth story going while keeping a close eye on risk? Let's check out their blueprint for the future. It all comes down to these 4 pillars. They're playing a classic phygital game that's physical plus digital. They're combining that on-the-ground expansion with some really smart tech to build their brand and scale up efficiently. And when they talk about tech, they really mean it. This isn't just a buzzword. They're using ADAR for instant customer verification, machine learning for smarter credit decisions. And look at this. 99% of their applications are e-signed, and 96% of collections are digital. That is how you build a fast, scalable, and cost-effective operation. And at the exact same time, they are not taking their foot off the gas in the real world. They opened 24 new branches just in this past quarter. That brings their total to 290 across 15 states. This is them going deeper and deeper into the markets they want to own. So it all comes down to this, really. You've got a company with a super clear focus on a market that's been largely ignored. They've got a solid growth plan, and they've shown they can handle some bumps in the road. The big question is, can they keep executing that plan and actually turn these economic headwinds into a tailwind that pushes them even further?